Hey everyone, it's Mike and welcome to lesson number 4, point of control as confirmation. And this is I find this one more fascinating than in point of control as support or resistance, is because not a lot of people think about what happens after the trade. They're always looking for areas of support or resistance, but you have to manage the trade once you're in it. And point of controls help you keep you on the right side of the market. So before I begin, a brief disclaimer: this presentation is for informational and educational purposes only, should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right. Something that a lot of traders fail to understand is once you're in a move, you should always be watching for signs of confirmation that the move is going to continue or that the move is ending. And this is where the power of point of control comes in. Everyone always talks about, their exits, where they're getting out. But, one of the fundamentals of being a successful trader is letting your profits run. Well, how do you let your profits run? Is you need confirmation that the move that you're in is a good trade. And when you enter along for the market to continue going up, you want to see additional buying coming into the market. Now remember, there's two types of buying. There's aggressive and passive. Aggressive buying is easy to see as the offer will get lifted, and you might even see buying imbalances if you're using an order flow chart, a volume footprint chart. Passive buying, which is indicative of support, will show up in the order flow because you're looking at the footprint chart. But the quickest and easiest way to see passive buying is with the point of control. Oftentimes, you will see point of control on moves up in areas where you have strong passive buying. Just as in moves that start turning down, you're going to see strong offers that line up with the point of control. So look for point of controls appearing near the bottom of green up candles in the move up, and what that shows is supportive buying flowing into the market, absorbing the selling orders. And the same would be true if you're looking at point of controls in down bars. Look for them near the top. All right, you'd look at the bottom of green candles and the top of red candles. So support would be on the bottom of the bar. Obviously, resistance should be at the top of the bar. Point of control can be used to confirm the direction of a move or confirm the market is consolidating. Markets have basically 3 different stages, right? They got a non-trending market. It's recognized by point of controls being clustered at or near the same price level. Then you got an up-moving market and a down-moving market. In an up-trending market, it's going to be characterized by consecutive rising points of control over a series of bars. A down-trending market is characterized by consecutive declining points of controls over a series of bars. Okay, here you have point of control. It's all over the place. You think, what the fuck, man? Why do I gotta bother looking at all these points of controls? I got one up here, down here, a couple together, one the same level, down here, up here, down here. I can't make heads or tails. When you see it like this is often a sign of a market going sideways, no direction yet. It's not until you notice as you break out, you're starting to see higher points of control. Right, here's a move up. Look at the point of controls: higher, 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 higher. On the move down, you're looking for them lower, 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 lower. I mean, I don't want to oversimplify trading that you think that trading is too easy, but this is what happens, right? You get points of control moving down in downward moving markets. Point of controls moving higher in markets trending up. Point of controls sort of bouncing around back and forth in markets moving sideways. That's the reality of it. And point of controls help you see that. You have to be able to understand that. If you're trading in here, I don't know what position. Anything. I don't know what position I'd have. I'd be long, then be short. They're just bouncing around. Point of controls just sort of lining up. You got one here, one here, one here, one here. These are all almost the same level, within a tick of each other. Okay, then you get up here, I got point of control. Then over here, I got point of controls at the same level. Here, I got a point of control. It's almost, you can almost just draw lines out going across here of areas that we're just bouncing back and forth between with the point of controls. It's not until you start putting some things together. Here I thought maybe the market's, here we're starting to break out, point of control higher, 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 but then boom, it's point of control in a down candle, a red candle up near the top, which is indicative of resistance selling, and the market sold off. Then all of a sudden, wait, okay, now we're starting to turn around. Passive buying coming in here in this point of control towards the bottom. You pair up a couple here. This is a very bullish indicator, a very bullish setup right here, and the market keeps going higher. But I'll talk about these setups in lessons 6 and 7. So again, a sign of a healthy uptrend is point of controls migrating higher as price moves higher. When the point of controls are bunched together, it's a sign of sideways activity. A sign of a healthy downtrend is point of controls migrating lower as prices move lower. Here, prices going back and forth. Boom, boom, boom. But then look, it straightens itself out and continues to move up. Okay, point of control sort of back and forth here. Up, down, down, down. Then all of a sudden it lines itself up here. It's like, I've got a kid in kindergarten, and it's like time to go. And everyone's sort of running around getting their jacket and stuff. And then they line up nice and neat. You start seeing it right here. Boom, boom, boom. You'll pop up, and then boom, 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 boom as the markets move down. All the kids are done running around, doing whatever, and they've all lined up in a straight line, and it's ready to make its move down. Now, if Isaac Newton was alive today, I think he'd be a trader, honestly. He'd probably be a scientist, but there's a lot of scientists now are into trading, it seems. Previously, I talked about Newton's third law of motion. For every action, there's an equal and opposite reaction as supply and demand. But what about a trend? That's where the first and second laws of motion come in. The first law states a body at rest will remain at rest, and a body in motion will remain in motion unless it's acted upon by an external force. In other words, when a market is range bound and starts to break out. The second law explains the velocity of an object changes when it's subjected to an external force. Now, the difference between the first and second law is the second law has there's an extra participant in the second law, whereas the first law doesn't. It's in a second participant is the long-term traders, right? All day long, you got day traders buying and selling. Day traders love what do you want to call it? Non-trending days, because they like to fade moves up and moves down. They're looking for the range-bound days because they're just buying, bid, selling the offer, buying the bid, selling the offer. That's what they're trying to do. But when a market is starting to trend, what you're having is outside market participants, traders that have longer-term views than rather just the short intraday time frame. And again, point of controls, how can you tell? Right? It's because those areas where you got the heavy volume is where the big traders are. I'll say the big traders, because you don't know if it's one trader or it could be 1,000 little traders. 1,000 guys trading 1 or 2 lots equal to one big trader trading 2,000 lots. Honestly, you can't tell that. And anybody that tries, people talk about smart money, especially if just looking at price without looking at volume, there's no way to tell that. What the volume is. So what makes it smart? Well, they think it's because there's heavy volume that makes it, it's a big order, so it's got to be a smart order. Not necessarily. There's a lot of dumb traders out there that manage a lot of money. They just, fell backwards into a nice job, and they got lucky sometimes. But what I'm really concerned about is looking where the points of controls are. As we come down into the low, is there supportive buying? Or are the points of control towards the bottom as you start moving up? Point of control here. Point of control here, right? We just hit our bottom. This is a prominent point of control with the order flows trader. Then you start, okay, next bar. It's a doji bar. That's why there's no green or red. But point of control towards the bottom. It came right down to that point of control. Then here, market, it put in a little rally and it sort of came off again. Point of control down here. Look at this volume, 193, 185. That's the heaviest volume in that bar. Heaviest volume down here, heaviest volume. So every time the market starts to poke a little bit low, come down to testing those lows, there's buying coming in. Even here, next bar up, towards, as this bar closes, you form a new bar. It's forming some heavy volume in here, and boom, it shoots off again and just keeps going up. Just as on this move down, you got heavy sellers here, right, as the market's moving down. This is a Bund. This is a 4-range chart. Bunds, Bunds are great. Not a lot of people in America like to trade it because everyone's fixated on the E-minis, but it's a great contract to trade. If trade starts trading about 1 a.m. Chicago time, cash market for it opens at 2 a.m. Well, daylight savings, different time I believe, but that's the time. But look at this. On this move up, where do you see most of these point of controls? They're towards the bottom of the bar. One tick off the low, 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 at the low. This is what you like to see in a move up. You like to see every time it pops up, comes back a little bit, more supportive buying. More supportive buying in here, in here, in here, in here. That's what you like to see. So physics aside, forget it. I don't expect everyone to go crack open the old college textbooks. Point of control is going to help you determine the direction of the market. When the value of something rises, the price for it increases, just as when the value of something decreases, so does its price. It doesn't take a rocket scientist to know that. That's just, everybody knows that. When something is scarce, prices rise. Right? If something's in demand, prices rise. Same thing as when something is, there's a lot of supply. It's coming up on Halloween. You see the price of pumpkins generally going down because as more pumpkins come to the market, closer to Halloween, after the 31st, no one's going to be buying pumpkins anymore. So, eventually prices will go down because everyone's saying, I got to sell more pumpkins. They keep harvesting them out of there and putting them on display, and then prices keep going lower. I mean, that's basic economics. They said you don't need to get a PhD in Newtonian physics to understand that. That's just basic stuff. So for a market to move up, there needs to be buying, right? Most often we think of aggressive buying when the market's moving higher. However, when you're seeing strong passive buying, that's also a strong sign of a market moving higher. The point is that I'm trying to make is markets don't just move higher on strong aggressive buying. Yes, they go higher because people keep lifting the offer, but what's behind that is the strong passive buying. Think of it like an army, right? An army is going into battle, right? You got the guys on the front line, the infantry guys, charging the hill. Well, how do they able to keep that hill? Is because they keep going up. Then the heavy artillery keeps following behind them. That's the strong passive buyers. That's going to support them. Just as the infantry guy that goes running up the hill, he's supported by the cannons behind him, shelling the people in front of him. Passive buying appears in markets that are moving up because big traders are bidding up the market and their bids are absorbing the aggressive selling. When an institutional trader has a large order, he just doesn't execute it at the market. You don't just come in and say, buy me 5,000 E-minis, click, at the market. No, he buys a couple hundred here, a couple hundred there. He works bids, bigger bids. He hides the size. There's all different ways of executing it. But what happens is they're trying to minimize the market impact of the order without moving the market, right? But it leaves its trail in the order flow, right? If you're looking at price action, you're not going to know that there's a big order going through because you're not looking at the volume. But if you see, gosh, the bid side keeps getting bigger and bigger and bigger and the market's not budging and not going lower, but people keep selling the heck out of this market, volume on the bid side, traded volume goes from 300 to 500 to 800 to 1,000, 1,500, 1,600, 1,800. Then finally the market shoots up. That's information that will oftentimes show up in the point of control. Like when you see, I was going to say it's going to show up in the order flow, but specifically it's going to be there in the order flow. Go back here, right? What's happening here? Like here, the market's going up, starts coming off a little bit, right? It met some resistance selling, point of control at the top here, starts coming off. Buyers are down here, selling this bid, even turned offer. Even when it goes turned offer here, 1,072, it's trading, 42, 43. Buyers just come in, scoop it all up, move the market higher. What's happened is you got a little bit of a pullback. There's strong passive buyers here bidding this market at 44, 43. Then when it goes 43 offer, people are saying, that's too good a deal. They buy it up, scoop it up. Market moves higher, higher, higher. Again, prominent point of controls, you know, here, here, right? But look what happens after this prominent point of control. Heavy volume towards the bottom of the bar, right? Yeah, I've got a prominent point of control. That's what I like to see. Okay. After I get, you know, once I'm long, I like to see the supportive buying coming in. You know, supportive buying coming in, that this market's going to keep going higher. You got it here, you got it here. Do you have any resistance selling after you hit this resistance level? No, it just shot down really quick, hit an area of support, then moved back up, right? There was no more resistance selling down here. So just as passive buying appears in up moves, passive selling appears in down moves. The passive selling is often indicated with point of control appearing at or near the top of a down bar or red candle. Passive selling here, right? 302, it's an imbalance. Yeah, 24 against 302. All right, what's happened? He's got strong passive offers. Market hit your swing high, some selling down in here, right up here at this high. Market just goes sideways, starts making a move back up. Okay, maybe we're going to go test that high again. Wait, there's passive selling in here. All right, and again, oftentimes that's going to show up. How does that reveal itself in the order flows? It reveals itself. Oftentimes the point of control is going to be somewhere up near that top of that down candle or near the bottom of an up candle. So point of control at the bottom of a green candle, good. Point of control at the top, near the top of a red candle, good. Point of control in the middle, that's what you expect. Point of control at the bottom of a red candle, you know, that's, I don't put much weight into that in my studies and analysis. It hasn't been anything very strong. Like you have this high up here and then point of control down here at the bottom. Not necessarily. You know, in swings, swing highs, swing lows, highs of days, lows of days, okay. It can help you identify that it rejected those prices up there. But there's other things in the order flow that can key you in on that as well. But this is really revealing. The red candle with point of control up near the high of it, or a green candle with point of control near the bottom of it is gold, basically. So this concludes lesson number 4. In the next lesson, I'm going to discuss using point of control as stopping volume in the market. And this is one of my favorite parts of point of control. Is you see this very often, and the markets just turn on a dime. This is pure support and resistance in order flow, and it can key you in on some excellent trades. So I'll see you guys on the next lesson. Bye bye.